But Kunal, what's the first trade looking like? We've been actually testing 19,800.
Yeah, 9,800 for the Nifty and 45,000 approximately on the bank Nifty. So there are a few more strong psychological levels which are being tested for the indices. So we need to see how the index pans out in the first hour or so. In terms of opening trade, I would stick to large cap names and the more low beta stocks. NTPC is something which I would highlight at current levels. Stock trading at 240 odd mark in terms of futures looks attractive as a good contra bet, and given the kind of market we are into, I think it makes a lot of sense to stick towards a lot more defensive stocks.
All right, let's find out what's on Nooresh's radar. And Nooresh, just taking a look at the overall market open this morning, what is your sense given the fact that we are continuing to remain on the back foot?
So closer to 19,800 is where I expect a bounce from. So should see some bit of a bounce. May test 19,750, 19,800 in the day and then bounce. On the stock specific side, good relative strength has been seen in Federal Bank. So that looks promising for a breakout going forward.
Dhiraj Agarwal joins us. Let's understand his view from the market, where is margin of safety and what exactly is he communicating to his clients. Dhiraj, good morning. Thank you for joining us. After the recent run-up and looking at the macros we are staring at, what is your house advice? What are you indicating to your clients?
So at this point of time, what we are looking at is markets are in a zone where one needs to be very, very selective and very, very quality focused. I don't think it's a bubble yet. There is more headroom for the market to go up, but it will not perhaps be as smooth and as easy as what we have seen in the last 4 or 5 months, where almost anything and everything was flying. It's time to be a bit more selective because the valuations are, I mean, it's high, but it's not ridiculously high. And hence, caution is warranted at this point. Being selective is, I think, a good idea.
Why is there such a marked difference in what's happening in the small cap space versus what's happening in the large cap space? The reason why you call them large cap is because they are better managed companies, better return ratios, and they have better moat around their business. They should come under premium. Right now, if you look at mid cap, they are at a premium to large cap. If you look at small cap, they are at a premium to mid cap. And if you look at SMEs, I'm not even getting there.
Yeah, that's true actually. And the feature of the market in the last 1 year actually started 2 years ago, but it's been very, very pronounced in the last 1 year. This is what I call the growth chase. And we have seen this happen a number of times in the past, especially when the retail participation in the market is very, very high. So anything which has a higher growth rate simply is getting demanded and bid up at a higher price and at a higher valuation. I mean, take the example of IT sector, for example. On a TTM basis, persistent is now trading at a premium to TCS. Persistent growth rates are higher than TCS. And that's the growth premium the market is willing to give. Remember, in the last 2 years, the market has become very retail oriented. This reminds me a little bit of the 90s phenomena. As per my estimation, approximate direct inflow into equities, this is outside of the inflows into the mutual funds by retail investors, is to the tune of $20 billion a year. This is a large number because when FIs pump in $20 to $30 billion in a year, we consider that as an outstanding number. So retail is putting in $20 billion direct. Retail is looking for only one metric, which is growth, and growth is being bid up. So across sectors, you will find that irrespective of market cap bracket that stocks or the companies fall in, if a company is delivering higher growth rates than the industry average, it's trading at a premium.
Dhiraj, so just understanding, I mean, where is it that you actually find value on the table right now in the market? And, given that pretty much everything is looking frothy and discovered.
There is no deep value. I mean, there might be some places in the market. So there is no longer deep value at this point of time. There is value only relative to the current outlook or current growth, right? So which is the phase we are in, and which is why one needs to be very, very selective. Mind you, the growth pricing or the price earnings multiple going high because of high growth rate is a double-edged sword. When the growth rates are high, the P's expand, and hence the stock price actually compounds at double the speed as the earnings growth rate. But it works on the reverse as well. If the growth rate slows down, the P contracts. So, which is what I started today's commentary with, that we need to be very, very careful and selective and focus more on quality.
The data coming from US Fed is clear that US economy will expand. They have changed their guidance from moderate to solid. What does that mean for IT? I mean, if US does well, banks will do banks will do well, IT will do well.
So US economy is actually surprising most of the soothsayers or naysayers with its strength, right? So we started the year with a very clear outlook that US will slip into recession by the middle of this year. By end of 23, there will be rate cuts. That narrative has gone into one of that of soft landing and possibly some rate cuts by end of 2024 and maybe one or two rate hikes prior to that. So US economy is very resilient and strong. But at the same time, one needs to take into cognizance where the US economy's strength is coming from. So there's a little bit of intersector shift. So the current strength is coming in from a huge amount of investments going in post the IRA Act. So either in EVs or semiconductors and manufacturing areas. So there is a little bit of shift from, let's say, tech or consumer strength back into manufacturing. So that changes the composition of the economy slightly. So I'm not too sure if just reading the headline number at GDP means that the IT earnings numbers is going to get revised up very soon. But I think the worst for IT is behind. I mean, I don't expect any more earnings cuts. I don't expect any more cuts coming in because US economy can slip into recession. That fear is off the table.
Dhiraj, morning. Also wanted to understand what the outlook is when it comes to IT, because rather pharma, because while the stance continues to remain positive, just wanted to know exactly what kind of companies within this space are looking attractive, and are you at all not worried about the expensive valuations that they command?
Pharma valuations, I don't think have become ridiculously expensive yet, despite a strong outperformance in the last few months. Remember, I mean, my view is that the US generics is bottoming out after almost 6 to 7 years of high teens price erosion. It's now settling down to mid-single digits kind of a price erosion annually, which is excellent for Indian pharma companies because that's the kind of price erosion Indian pharma companies are prepared for, can absorb and grow. Most of the Indian US generic facing companies have excellent pipelines. And the big pain in the last 6 or 7 years was very steep price erosion. Once that settles down, we can see secular 4 to 5 years, maybe more steady earnings growth coming in the pharma space. So if I connect it back to what I said just a few minutes ago, that markets at this point of time are looking for sectors or companies which can grow faster than the market, which can grow better than the industry average. And that's the space that's been chased because growth is now becoming a little bit scarce again. And given that context, once the conviction sinks in that the pharma revival or the pharma earnings revival, not the stock price, the pharma earnings revival is more sustainable and more like 4, 5, 6 year kind of a phenomenon, I think the valuations will sustain.
Why are private banks underperforming, Dhiraj? I mean, that is the safest, the best, and the easiest trade. Yet it is turning out to be the worst trade for this year.
Yes, it's markets have become a little rotational in nature. And the other thing, and this is again looping back to what I said, that the markets are very, very retail heavy. So retail has actually become price setters and institutions have become price takers in this market. And it's back to those 90s style of investing where people looked at relative valuations, relative ROAs and relative growth, and then just chase the ones which are cheaper. So for a long time, we had stopped talking about this, right? That, I mean, you took the example of banking, so let's stick with banking. That the best player in the sector is, let's say, 2.5 times price to book. Then something else which is delivering similarly good numbers is at 1.5. So you buy the one which is at 1.5. So which is actually benefiting the PSU banks. Even within PSU banks, mind you, last 9-10 months, SBI is actually flat. And the bulk of the action in PSU bank has moved to relatively cheaper names within the sector. So PNB is up, 40% YTD. Bank of Baroda is up 16-17% YTD. SBI is flat. Kotak and HDFC Bank are negative. So that whole relative valuation with respect to growth is the play in the market right now, which often happens when retail money actually becomes a dominant force.
Sure. So, Dhiraj, as a portfolio strategy, what is it that you would recommend, viewers watching this interview do? Book your profits, at least when it comes to the frothy small and mid caps. Keep the powder dry. At some point, there will be value and you can buy more of the same.
I don't see a deep correction in the market. And the reason for a deep correction not coming in, there could be shallow pullbacks, yes, of course. The reason for perhaps a deep correction not coming in is that the large cap valuations are not frothy at all. So my recommendation at this point would be to book profits in small cap or mid cap names where clearly the investors have become lucky, where the earnings are not really supporting the current valuation. So one should take a look back at earnings and valuations and say, well, this one ran up without any too much of earnings bumper, but only on hope and narrative. And incrementally start moving a little bit of money towards large caps, because another interesting metric I saw recently was that FII overweight position in India in the EM funds is only 100 basis points right now. At peak, which is about 2016-17, it was 500 basis points. So if that positioning changes over the next year or two, bulk of the money will once again come into the large cap names. So relatively speaking, I think some amount of gradual shift out of mids into large, especially the mids which are looking frothy, is I think what one should do.
All right, Dhiraj, really appreciate your time. Let's look at those small PSU banks. They've come back. Markets can remain extended for an extended period of time. All I'm saying is that when hope and narrative it takes over, then risk and margin of safety is compromised. Never forget that. Hope and narrative in the short term will have a larger role in terms of what risk and margin of safety will be. I'm simply putting facts out on the table. And we've got a view coming in from Neelkant Mishra as well, in terms of where he feels that markets are headed, where the margin of safety in the market is, and if US economy is showing resilience, why it is showing that kind of a resilience.
The reason why the US recession has not occurred yet is because of a significant expansion in the US fiscal deficit. So they're effectively adding $1 trillion of debt every month. I think most people who expected that hike in interest rates would drive a US recession had not anticipated that their annualized fiscal deficit would be upwards of 8% of GDP in this year. Now, that itself has its own ramifications. So the risk-free rate for the world, which is the 10-year US bond, the yield on the 10-year US bond, is now at 4.37. And in fact, what we have been researching and flagging is that a lot of this 2% point increase in the 10-year bond yield in the US, which is the risk-free rate for the world, is something that is going to last for a while. It is very difficult for that rate to come down. One very simple observation to support that is that one of the reasons the US fiscal deficit is so high is that their tax collections are not good enough. And so this means that some of the valuations that the markets have been used to, and in the 10 years preceding COVID, where the US mostly had a tight fiscal loose monetary stance, and now they seem to have a tight monetary loose fiscal stance, will mean that the PE multiples that we are used to will not apply. The muscle memory of the market will be tested.
All right, let's move right on then and connect with the corporate voice. Happiest Minds is in the spotlight. We want to understand a little bit more about their overall business outlook, their capex plans, margin guidance, and view on acquisitions. Venkatraman Narayan is the managing director and CFO of the company and now joins us on the show. Thanks much for taking time out. Let's get straight to it. Your 25% growth guidance has been factored into the acquisitions. Can you tell us a little bit more about your overall revenue guidance now? Are you looking to scale it back, given that we haven't heard anything major yet in terms of acquisitions?
Good morning. We had given a guidance of about 25% in dollar terms, and it was, like you rightly said, including acquisitions. In the first quarter, we did about 3.6% in dollar terms. So yes, if you take that kind of a growth, we wouldn't touch that 25 unless we close those acquisitions that we have in the pipeline in the second or the third or the fourth quarter. We have got a couple of good names in the pipeline right now, and hopefully keeping fingers crossed because these things, acquisitions tend to be binary. We hope to close at least one or two in the next quarter or 6 months.
Right. Sure. So, what was the organic growth, Venkat, that you were factoring in? Or, so say, for how many months you were anticipating some acquisition to kick in?
There is, we had overall taken 25%, but if you ask me to do a back of the envelope calculation on the organic growth, that would be about, let's say, between 15 to 20% would be the organic growth number that we had factored in.
Are we likely to hear anything about an acquisition soon? And if so, what size, scale, geography?
Like I mentioned, early days, we've got a good pipeline. We are in active discussions and engagement with respect to how to go about doing the acquisitions. But very mindful of the fact and the risk that these tend to be binary. If the valuations are unrealistic, or if we don't see how we can draw synergies from an acquisition, we will have to step back. So it's a touch and go kind of situation, but at the same time, a decent number of names which we are pursuing, and we are reasonably confident on that.
There is a very interesting data which I think is worth revisiting, and which is about the commentary from US Fed about US GDP going forward. They've almost doubled their GDP outlook, GDP growth outlook. Now, there is a direct correlation between what US economy will do and what will happen to IT. In your assessment, do you think 2024, calendar year 2024, could be a turnaround year?
I think the industry is looking for a pickup starting Q3 of this year. Q3 typically tends to be a weak quarter for the IT industry, given the holidays and the holiday season in the US, which happens to be our largest market. But despite that, we are looking to see an uptick in the spend, and which will continue into Q4. And then, like the press has been reporting, 24, 20 seems to be a good year for the tech industry. Second point I would like to make is whenever there has been a correction and a revival, the tech industry has been the first to come out of that, whether it was in 2000, 2004, 7, 14, whichever year post-COVID, if you look at it, that has been the trend. So, the tech industry first gets the shorthand, and then quickly picks up when things starts improving.
How much of your business you would say is coming from the pure AI generative space? Because that's what everybody needs to understand in terms of the migration.
There are two things. Like every other IT company, we are very focused on AI. We are, as we speak, creating a division unit to make sure that our focus is completely on that. You'll hear our point of view very quickly and the kind of organization that we are putting to address that. But while that's happening, we are seeing quite a bit of traction within our existing customers for integration of AI tools and AI capabilities into the existing platforms and solutions that we are giving to them as part of platform engineering or the digital transformation exercise that we have undertaken for them. We are yet to call out the number for AI, but we are seeing significant traction, and you will hear about it. Like when we started with IoT, we started reporting IoT numbers. Then we have been reporting IP-led services numbers. We've been doing the same for consulting in a manner of speaking, and automation for the last few quarters. Once we get a grip of how to carve out this number, because there are no pure AI projects. These are integrated into the existing customer deliverables, and we need to slowly carve these out and report them as a separate number. But there is quite a bit of demand coming in from existing customers and also new customers, so that it's almost like that foot in the door kind of a thing. You're able to give your AI solution. When you talk about transformation, you talk about it through AI-led transformation, and that's how you get into the customer. And then there are existing customers as well who want us to do AI-led projects.
So will AI be more like a Y2K kind of a hump where it will look very big in the short term as the migration happens, but eventually it would be forgotten. So let's say hypothetically, if you're talking to any large IT company, 3 years from now, AI would be part of their DNA rather than something which would have caused disruption.
I would go with that second line. It would be part of our DNA. It would become one of the key arrows that we will have in our quiver while we deliver capabilities. The jury is out on whether AI will have its independent say or it will become more like an IoT. I'm talking from a services standpoint. Internet of Things was one of the major change factors that happened a few years back, but now you see it's very well integrated into all the IT projects that we today deliver. Similarly, AI on the demand side will play a critical role, an important role, because it's going to help efficiency in coding and delivery. And there is the demand side, which is where the customers want us to integrate new solutions, new capabilities on the demand side. So there is an impact of AI both on the supply and the demand side, and we have to play that to make sure that we don't miss this uptrend that you have. But in 3-4 years, like you rightly mentioned, it will become a part of our normal delivery. It would cost huge amount of delivery efficiency to happen within the supply side, while at the same time the demand would be higher, and that would make up for any change on the supply side.
All right. Thank you so much then for taking time out and joining in and giving us an overall view on how the business is shaping up. As of now, no concrete acquisition plans, but things are in the works and perhaps may not achieve that guidance of 25% in dollar terms. Tell you what, with news that the index is lower by about 1/3%, 19,823, we'll take a very quick break, but be right back. Back with first trades right here on ET Now. Let's also mark what's going on in the markets. We're down about 0.5% or so for the frontline indices. Broader markets, meanwhile, are managing to eke out just a mild gain. But for now, it's looking pretty flattish. Let's just also tell you what's under pressure within the frontliners. HCL Technologies, heavyweights like ICICI Bank. Take a look at L&T as well as TCS down under pressure. And on the flip side, you have some resilience in the likes of a UPL, Hindalco, Adani Ports, and even an SBI for that matter, that's managing to hold out in the green. Within the broader universe, names like SJVN under pressure, ditto with KPIT Tech, HCL Technologies, Coforge, as well as something like a Lemon Tree Hotels. But let's find out how things are shaping up when it comes to Shriram Finance and how they're reacting to the RBI's list of upper layer NBFCs. We've got Umesh Revankar, who's the Executive Vice Chairman at Shriram Finance, now joining in to discuss that and more. Thank you so much for being with us, Mr. Revankar. To begin with, the RBI has zeroed in on 15 NBFCs, placing them in the upper layer category. You're said to be on that list. What is your initial assessment of the impact? Are you in compliance with most of the stricter regulations? And if not, what measures would you have to take in order to comply?
Good morning. I think this is a 1 year old because the list was already announced earlier. They had revised the list now. So we are already into the system or into this new dispensation for more than a year. But before that, RBI did indicate on the upper layer and other layers for more than 3 years back. So all the NBFCs who are in the upper layer or whichever layer they are in full preparation and they understand the requirement and also the regulatory supervision and the regulatory requirements. This has all been addressed, and we have been continuing with this for nearly 3 years. So we don't have anything to have surprise on the same.
All right, fair enough. I just want to move right on and talk about your overall segmental growth, vehicle financing, MSME, gold loans, etc. Can you just walk us through how these segments are performing and where is it that you're seeing leadership or an outperformance in terms of sector?
We are clear leaders as far as vehicle financing is concerned, including the two-wheeler financing, because all vehicles, all commercial vehicles, we are the largest one leader there. And in the two-wheeler, again, we are the leader there. We have the largest presence across the country. So we are continuing with our growth there, and we do see a good growth opportunity because there are two things. One, the resale, sale of new vehicle is continuing to be good, and it's growing month on month or even year on year. Plus, we can also observe that the resale values of vehicles are very strong and good. That really helps us in asset quality. So when the resale values are very strong, that means the demand for the second-hand vehicle is very good. The economy or the overall the activities are utilizing the vehicles or the machineries or tractors or all the what to call equipment that is being used in the economy. So that all sounds very good for us. So asset quality continuing to be very strong and improving quarter on quarter. I think the credit growth will be a decent one. For us, we have already given a long-term guidance of 15%. But first quarter, we did had a good quarter with around 18% AUM growth. We should be able to continue to grow in similar lines.
And do you expect the pressure on your NIMs to ease as well going forward?
See, as of now, NIM will remain at current level. It may not ease immediately because the indication from the inflation and RBI standpoint and overall liquidity in the system is likely to remain at present level or maybe a little tightened next quarter or two. It all depends upon how the agri output would be. The Kharif output would be something we'll be knowing in the first week of October because there has been disruption in the rain. And as far as Rabi crop is concerned, I think the rainfall has been reasonably good. Catchment area, there is good rains. So that should really help in Rabi crop. As far as Kharif, there is some uncertainty because of delayed rains. There is nothing to worry about. There is not much of a shortfall in the rain, but there has been delayed rain, and which we would like to assess by the end of September or the first week of October. So once we know that, then the inflation concern are addressed, especially on pulses and the vegetables, etc. I think then we should be able to easily gauge the RBI mood or the overall indicative on the liquidity that is being available. So as of now, we do expect a little tight liquidity for next 2 quarters to contain the inflation. So that will make the NIM expansion a little challenging, but we should be able to maintain current net interest margin.
But with ICCR dilution, don't you think liquidity will actually come back?
It should come back because right now in September, this advance tax, the money gets little locked. So there is a temporary shortage of liquidity, but it will come back is what I feel. I think next couple of quarters it will definitely help us to gauge the mood of the country and also the economic growth that is possible. So if the economic GDP growth continues to be above 6.5, I think we should be having a very good year for the full financial year.
Okay. If I look at the economic data, two-wheeler sales are not there, HFCs are not picking up. There is a stress. It could be agrarian economy, it could be the COVID shock, but the rural economy is not recovering. In that kind of a backdrop, we've had poor monsoon. So I'm sure it will have an impact either on demand or repayment ability by borrowers.
See, the way I look at it is I am not looking at the benchmarking of two-wheeler numbers on par with the 2018-19 numbers. If I compare the 2018-19 number, the two-wheeler numbers are not great. But year on year, it is growing at 10%. And even month on month, sales are good. So I don't really see stress there. See, there is also a possibility that the people are shifting from two-wheeler to car in certain pockets, especially in the southern market. I do see increasingly the used vehicle, two-wheeler is getting mature, reaching a particular level of what call maximum limits, and people are turning to own the four-wheeler. So there is more wealth that is getting created in the rural. I do agree that there has been some kind of uncertainties on the rainfall or disruption in the rainfall, but overall rainfall has been good. It is not deficient as per the definition of deficient. So that means there has been rain, a little sporadic ups and downs, but even last year it was same. But rain kept continuing. It is disrupted rain, but it continued in month of even September, October. So I think there should be a reasonably good expectation on the rural economy, and government also has increased the MSP to larger number of agri output. So I think that all should help us.
The other thing, Mr. Revankar, I wanted to understand was about the progress that you've made so far with regards to your tie-up with Paytm to get on their digital lending platform. Tell me, what is going to be the nature of these loans? Are they going to be largely unsecured?
Basically, what we intend is Paytm is in the system for more than 10 years now. The way they started, and they have built a huge franchise of good merchants and good manufacturers on their platform, and they have track record. We would like to lend to small merchants. We are targeting small ticket only, around 1.5 lakh ticket size lending to the small merchants and distributors, so that they can manage their inventory, or they can manage their working capital requirement. So that is the agenda, or that's the plan. So we are to build a credit rule engine and start lending on it. It will take some time, but we should be able to do it. So it is basically to reach out to the customers whom otherwise we are not able to reach. Even though we have 3,000 plus branches and large field force, some of them would be out of our reach. So we would like to reach to them and offer them through a digital platform, so that entire transaction will remain on the digital platform with less supervision or less physical requirement or touch point requirement. So that's the idea behind it. And once the initial test get successful, then we will expand it. So initially, we would like to restrict it to a small geography, then we'll expand it.
All right. And I just wanted to also get in a sense from you as to what the outlook is and some of the measures that you plan to take in order to maintain your overall asset quality.
The overall asset quality has been improving for last 5 quarters, and it is likely to improve for next 2 quarters also, because the overall underlying economic activity, demand, the utilization of vehicle, earning, everything is positive and good. We hardly see customer not able to pay because of the economic condition, or not able to ply his vehicle, use his machinery, surrendering his machinery. Nothing is that happening. In fact, this repossession and the taking back the asset is virtually nil. So to that extent, there has been excellent progress for all our customers. So I do see there is an improvement in the asset quality going forward. Our credit cost in the first quarter was 1.67, much below our long-term average of 2% credit cost. That means we should be able to continue this good run for a longer time.
That note, Mr. Revankar, great to have you on the show. We'll let you go on that note.
Thank you.
Thank you so much for talking to us. We'll take a very quick break with news that we still continue to struggle at that 19,850 mark for the futures. We've breached the 19,800 level as well on the Nifty spot right now. So that's some significant weakness that you've seen from that 20K mark onwards. Key pressure points, ICICI Bank, that's down nearly 2% as we speak right now. There's technology which is actually feeling the heat today. So HCL Technologies, LTIM, TCS, they're all in the red. Excuse me. Some of the other heavyweights like an L&T, IndusInd Bank, ITC, they're also weighing down on the markets. But on that note, we're going to take a very quick break. When we come back, a very special chat lined up on the other side.
Uncle, it is the perfect bachelor pad.
तो कब लेना है आपको?
अरे पहले बैचलर तो बन जाने दीजिए। डिवोर्स की फाइल घूम रही है कोर्ट में, कुछ साल लगेंगे अभी।
मतलब अभी नहीं खरीदना है?
अरे अभी खरीद लिया तो ये घर भी उस फाइल में अटैच हो जाएगा, समझ रहे हैं ना आप? मस्त घर है वैसे, मजा आ गया।
घर तो बेचना है, पर ऐसे चैलेंजेस का क्या? इसलिए housing.com पर से housing.com का हाउसिंग असिस्ट फॉर रेडी, प्राइस मैच एंड वेरीफाइड बायर्स।
Good to have you back with us. This is First Trades, and just checking in on what's going on within the broader universe, because while it's absolutely flat for the broader markets, you have select names that are under pressure, the likes of a Lemon Tree, IT as well is really at the receiving end. So an HCL Technologies is under pressure, KPIT Tech as well losing steam, and SJVN continues to remain a key drag in today's trade. UCO Bank, DCB Bank, Bandhan Bank, Bank of Maharashtra, Nikunj seeing some sort of a pop, by and large bucking the trend after what we witnessed yesterday.
Savan, look, markets can always remain extended for an extended period of time. My limited point is that sometimes narrative really takes over and then margin of safety is compromised. Anywhere in the market, you should always be cognizant of that. I don't think this is the end of the bull market. Clearly, it's not the end of the bull market, because for end of the bull market to happen, you need something to go wrong globally. Your valuations have to be very frothy, or we have to have large IPOs. They are not there, and large cap stocks are not very expensive. So there is no. I don't think we are around. The deep correction is around the corner. However, when there are excesses which are getting built up in some pockets, you just need to be careful when you're planning to just trade the momentum there. That is my limited point here. Look at railway stocks. They've started, they've hit a pause button. They've not retreated, they've hit a pause button. Suddenly, a lot of defense stocks also, they've hit a pause button. And this is not my opinion, this is opinion which is universal opinion, which is coming from a Neelkanth Mishra to a Sanjeev Prasad to just about everybody who's come on the show has said that, look, with defense and railway stocks, we like the businesses, they are great multi-year trends, they are huge play on where New India is going to be built up, but the stock markets are pricing in 2027, 2028 kind of valuation. So either you will see price correction in the short term or you will see time-wise adjustment in the short term. That's the point I'm trying to bring out on the table right now. Okay, Bir Prasanna, Group Head Group Head Global Markets with ICICI Bank joins us now. Let's take our conversation forward. Prasanna, good to have you back on ET Now. Thank you for joining us. Let's start with the latest communication from the US Fed. Last night, the communication was US economy has moved from moderate growth to solid growth. Inflation remains elevated and the labor market is slowing down, is still solid. I mean, this is the most bullish Fed I've seen in a long time.
Yeah, you're right, Nikunj. I think the policy yesterday was marginally more hawkish than even what the expectations were, which were anyway hawkish in the first place. So I think significantly the reasons for why I'm saying that is that number one, before I come to what you said, number one is the rate trajectory. That is what the Fed has indicated in its dot plot. So number one, they've retained the rate hike in the dot plot for this November meeting, while market is still at a 50-50 kind of a probability. More interestingly, the rate cuts in calendar year 24, they've reduced it from 100 basis points of rate cuts to 50 basis points. And what the market was expecting is only for a 25 basis point reduction in the dot plot. And more interestingly, also, instead of moving the rate cuts forward to calendar year 25 or calendar 26, the reduction of 50, they have actually retained the same extent of rate cuts that were indicated in the earlier one rather than increasing it in calendar year 25 and 26. So what this means is that the terminal rate in calendar year 26 is actually higher by 50 basis points, which is nothing but the 50 basis points of rate cuts which were taken away from calendar year 24 estimates. So this is the first reason why I think it is marginally more hawkish than what the market expectations were. Second, like you were rightly pointing, I think the growth inflation mix by the Fed projections is now stronger is for a stronger economy. Growth has been hiked for both calendar year 23 and calendar year 24. Inflation has been tweaked marginally higher again. Unemployment rate has been kept a little lower than earlier what they were projecting. And all of this kind of, substantiates the lower for longer theory that the market has been always, expecting it. And kind of it is also, having said all of this, it is also fair to point out that it is unfair to expect the Fed to actually be dovish in such a situation, because they have no option but to sound hawkish, because primarily, I mean, look at the example of what happened to ECB when they did a hike, but sounded out clearly that it was a last hike. The market actually went the other way, and financial conditions index eased. So I think till the time the Fed is confident that they will get inflation lower, unemployment range that they are wanting, and the growth in the range they are wanting, they have to keep speaking a little bit on the hawkish side. Incrementally going forward, Nikunj, I think data is going to be very, very key. Market actually knows that the Fed will be willing to change its outlook whenever data comes weak, but it needs to see that data coming weak. It is not going to take a view that data is going to come weak and hence sound a little bit more dovish. So that, in a word, in a kind of a thing, summarizes what exactly has happened in the Fed meeting yesterday.
Well, what are the chances, Prasanna, that this one more rate hike in the offing before the year closes that Fed has hinted at? You think the quantum could be larger than what the market is anticipating, or maybe go in for a pause and not have the rate hike? What could be the deciding factors, considering growth has actually picked up?
No, I would actually say that just like how the market is expecting, I also feel that the chances are just about even. 50-50 of a hike in November, and they, like I said, they have no choice but to sound hawkish, so they did that, and I think it's probably justified in doing what they are doing. And I think, like I said, it's very critical about where incremental data, comes. I mean, we have seen that a lot of data, consumer sentiment data, and even the consumer surpluses data, they have been on the stronger side, but there is at the same time indications that it is getting weaker. Inflation is also coming lower. So I think it's a 50-50 at this point of time. But if I have to put my bets on one side, I would probably expect growth to come down and marginally, and hence the Fed might not be hiking in November. That's what I would tend to believe. But I think data is going to be very important, and frankly, even the Fed has not made up its mind as of now. It's the incremental data that will make it swing this way or the other.
To also understand your outlook as to how investors should really be reading into the fact that the economic growth projections have been increased, with a 2.1% projection, that's more than double the June estimate, and also indicative of the fact that there's not going to be a recession anytime soon. Your take?
No, that's, I think, frankly, there's nothing new in that. That's also what the market has been saying over the last 1 month or so, that we are in for a softer kind of a slowdown. And all talk of recession, which was there, has been there right from, middle of last year or towards the end of last year to the middle of this year. All of that recession talk has given away to this soft landing theory, which is basically that Fed gets its way without a crash in the economy and inflation gradually slows down, which in a typical sense is actually, good from a longer term point of view, that we don't see the humongous hike in interest rates derailing the economy to such extent that we'll have to worry about recession. So it's good from that perspective. But markets will be reacting to what has been discounted in the immediate past. And frankly, sometimes good news from the economy is also bad news for markets because of the fact that you will not get the Fed to cut very soon. And a lot of bullishness was also, risk on behavior was also based on the fact that rate cut cycle is going to commence sooner than expected and all that. I mean, even if it's going to be the middle of the year, there was, like I said, 100 basis point of rate cut expectation. And now if it's going to be only 50 basis points, then to that extent, I think the rate cut cycle is much more dilutive and hence not so much amenable to the theory that lower rates will, bring in much more bullishness in the market. But from an economy point of view, I think we are headed towards a gradual slowdown, which I think is good news.
Closing comments. Do you think somewhere markets have already priced in this Fed narrative? Because the bond yields have moved higher, the dot plot has moved higher. So, there was a time when Fed was actually behind the curve between 2012 and 2016-17. They were really behind the curve. And financial markets, the bond market had moved ahead of it. The same thing is happening. The real economy has adjusted higher rates.
No. So I think with 5-year US bond yields at in excess of 4.5 and 10-year close to 4.4 or 4.45, the realization has dawned that we are in a high rate scenario at least for the next 1 to 1.5 years before the rate cuts start to play in. So to that extent, I think the bond yields have today, I would say, priced in for the incremental information that is available till yesterday, which is what the Fed came out with. So, but if it's all completely priced in, I would say that it's an ongoing process. If, for example, inflation were to come substantially lower in the next reading than what the market is expecting today, then you can be sure that market yields will fall. And on the other hand, if it were to come stronger, yields will go up. So that's a natural process. Also bear in mind that today's bond yields are also not reflective of just what the Fed is expected to do, but also reflective of the huge supply that's coming in from the US Treasury because of the higher fiscal deficit. So I think all in all, I would say that the market is very close to pricing in all kinds of news which is available at this point of time. And it's only incremental surprises on the margin that is going to, move it this way or the other. And having said that, like I'll reiterate the earlier point that market also now thinks, even now, that the Fed cannot afford to be a little on the dovish side till the time it actually sees data much more comfortable to be coming lower. And because it can't let the financial conditions index really come lower, and hence it will not be possible for it to speak on the dovish side till the time it sees data.
Great to have you on the show today. Thanks for taking the time out. Okay, that's more on how to read into the Fed's movement, or rather Fed's action or non-action in this case. Take a look at what the market is up to, because we've breached that 19,800 print. In fact, we're quite significantly falling quite a fair bit. 19,766 is where we're currently at, and we're almost about to breach 19,800 in the Nifty futures as well. By the way, ICICI Bank alone is now down 2%, which equates to about quite a bit of fall when it comes to the equity market movement, and I think this should be contributing about 30 odd points to the Nifty fall alone today. That's ICICI Bank. In trade for you, 966 is where the stock is currently struggling at. We'll take a very quick break on that note. When we come back, we'll have our chartists back on board and get you some trading ideas as well as Chartbuster charts.
Welcome back. Sub the 19,800 mark. We're nearly 570 points off on the Sensex as well, and lots of names under pressure within the rate sensitives, close to the lowest point of the trading day in just about an hour or so. Let's find out what our chartists are making of the trade setup and which stocks they're identifying as their chartbuster ideas. Kunal and Nooresh joining right back in. And Kunal, what are you flagging off today?
So it's a chart on ITC, and how the stock is just about getting into a zone of potential breakout, and we've looked at this in terms of the indicators. So the top indicator is what we call as a strong momentum indicator, and this is the neutral line, or what we call it as a zero barrier for the stock price. And whenever the stock gets into a breakout mode in terms of the indicator, we've seen that the stock starts to get into a trending move. Now this is the 100 exponential moving average for ITC, and how the stock over the last 2 years has been going into a phase of a rally correction, and the correction somehow halts closer to this 100 exponential moving average for the stock price. Even very recently, the stock has shown signs of a potential support at this 100 exponential moving average. Now what's interesting, as I said, is the indicator getting into a breakout zone. Whenever that happens, potentially we've seen the stock starting off a new uptrend and ending that wave of correction. So we are at a point where the indicator is very close towards a breakout, and if that happens, which means that potentially if ITC crosses the levels of 455, 460, we could be looking at a start of a fresh turnaround and hopefully a breakout of the previous swing highs for ITC with the medium to long term charts.
Okay, the stock we love to hate, or maybe now it has reversed. That's ITC. Kunal giving his technical expertise on it. Let's move right on and find out, Nooresh, which stock you've got that your eye on.
So that's a chart for Bandhan Bank. The stock has been a major underperformer over the last couple of years or more. Now, earlier 240 to 250 was a support which broke down back in end of 2022, and the stock went all the way down to sub 200 levels. Made a recovery towards 270, retested 210 levels, and now has slowly started making higher tops and higher bottoms over the last 2 months. And now is getting back towards that 250 mark. Today, the stock has come towards 250, showing a lot of strength. This is a major trend change possible on the stock. If it sustains about 250, 55, it should open up a move towards 300, 350 levels in the short term. Buy at current levels as well as on dips with a stop loss at 230.
Kunal, what about your stock ideas?
So 2 buy calls. IDFC First Bank is a stock which is still holding levels of 93, 94. So it's a buy with 100 as a target and stop loss at 90. And MCX after today's move is showing signs of a flag pattern breakout. So would suggest a buy 1830 as a target and stop loss at 1717.
Right. Nooresh, what about your stock strategies?
First is a buy on UPL, a bottoming out candidate, stop loss at 620, target price of 680. Second is a buy on Granules India, which looks positive with the last 2 sessions of relative strength, stop loss at 324, target price of 360.
Okay, let's move on. While it continues to correct for the equity markets and pretty much across the board, let's try and understand where is it that Latent View actually sees their business headed. We've got Rajan Sethuraman joining in on the show right now, the CEO at Latent View Analytics on the show. Rajan, hi, morning. Great to have you today on ET Now. Help us understand what are the demand trends that you're seeing across your segments, your technology, industrials, as well as financials.
Thanks for having me on the show. On the demand front, we see that it's still a little slow, especially in the financial services sector and in retail. Industrials, there's a little bit of action. We have, in fact, had some good conversations and some closures as well. On the technology front, as I had mentioned in my earlier interaction, the progress continues to be a bit incremental. We are likely to have 1-2 larger deal closures, but we are still waiting for those signatures. So in general, I see that the first half of the year has been a bit sluggish, and there is some expectation that there'll be a pickup in the second half of the year.
What is stopping you from using your cash on the book? I mean, you have a sizable kitty, which is, or war chest. If you think that growth is not that great, what is stopping you from acquiring growth?
No, nothing is stopping us actually. And in fact, we are in the process of evaluating several acquisition opportunities that are there on the table. Some of them have progressed as well, right, in the last few months. We are not close to signing anything at this point in time, but there is an evaluation process underway at this point in time. We will probably have more updates, right, once the quarter is over, right, and we are able to share the results.
Acquiring, I mean, in terms of a geographical presence or in terms of a customer base?
So we are actually looking at some specific niche areas. We are looking at data engineering. We are looking at supply chain analytics. We are looking at specific areas like revenue growth management and pricing analytics, for example. At this point in time, we are open to opportunities that have a customer base either in the US or in Europe, or they have enough potential, right, for customer opportunities in those geographies. So an ideal combination would be something that marries the technical, the functional, as well as the geographical priorities that we have.
Right. You know, last time you had highlighted that deal decision making is actually slow. Are you seeing any pickup over there?
No, that was what I was mentioning, right, in response to your earlier question. We have quite a few opportunities that have gotten into the pipeline. In the technology sector, for example, our experience has been in the past that deals can close anywhere from 2 to 3 months kind of a time frame. I'm seeing that it is almost double at this point in time. I mean, easily taking 4 to 6 months. That is one aspect. The second aspect is that in general, the conversations are about slightly smaller initiatives at this time, and organizations are unwilling to start any big new initiative. So that is also taking more time, right, to shape those opportunities. So combination of that means that the sales cycles have gotten longer. And that's been the case for the last 9 months or so. We are expecting that there will be some movement, especially in terms of utilization of budgets towards the last quarter of the year. For many of our clients, a calendar year is their fiscal. So we're expecting some closures so that they also get a move ahead, right, in terms of next year's planning on what they intend to do.
Looking at exactly a year ago, revenue 132, margins 28, profit 37. Your revenue has gone up, but margins from 28% have gone to 19%. So in an expansionary mode, normally operating leverage should kick in. What we've seen is almost like a 900 bips or 9% drop in margins. Why is that?
So yeah, it's a combination of factors. One is that we have significantly stepped up on the investments that we need to make in the front end, more so in underpenetrated markets, with respect to, for example, retail and BFSI in the US and Europe in general as a geography. So a year back, we had just one person in the market in Europe. Today, we have 10 people, plus we have a few advisors on board as well. So there's a lot of front-ending of the investments that have happened on account of this. That coupled with the general macroeconomic scenario and the sluggishness means that the margin has been impacted in the last couple of quarters. We are expecting that these investments will start panning out for us in the next few quarters, and the margin profile will come back to the earlier 25-26% range, right, over the period of time.
So when will the benefits of this kick in? I mean, in next 2-3 quarters, will you go back to margin range of 29-30%?
29-30% was never our guidance. I think that is also on the back of what happened during the pandemic. The margin range that we have indicated in the past is between 25 to 28%. We're expecting that we'll start getting closer to that trajectory in the next 2-3 quarters time.
Could challenge your optimism? I mean, could it be deal delay? Could it be US macro? What else? Or could it be AI?
It could be all of those things. I mean, obviously, the investments that we have made, for them to fructify it, there is also the need for the market to be responsive. At this point in time, as I said earlier, there is in general delay in decision making plus reluctance to take on new large deals. The good news for us is that all the work that we have been doing, that has been renewed, and we have been executing that work, and we have seen incremental growth as well. So we grew at about 4.7% quarter on quarter last year. We are expecting that a similar trajectory can continue, right, in the next 1-2 quarters, even if there isn't any big pickup from a new deal signing perspective. What we are, however, hoping for is that we can get back to a even higher quarter-on-quarter growth rate on the back of some of the opportunities that are in the pipeline that could potentially get to closure, right, in the next few months itself. So that's what we are hoping for. But all those factors that you mentioned, right, I mean, if there is a general dampness in the scenario, if there are other extraneous factors that come into play, they all could act as dampeners.
How would you map the competitive landscape for us? I mean, who would you say is your closest competitor, and what is happening there in terms of the competition?
So, I mean, our competition comes from 3 broad areas. One is all the other pure play analytics firms like us, which are many instances India-based, but are looking at US and European markets. And I'm talking about companies like Musigma and Fractal, for example, right? Then we have the analytics practices of larger IT companies and systems integrators, like an Accenture or Infosys, TCS. They all have practices, analytics practices as well. And finally, if it is a very well-defined problem, you also will have commercial off-the-shelf software and products available, right, which can solve with the analytical rigor that is required. So we see competition from all of them. Our advantage is our ability to marry the business, technology, and the math skills and expertise to go after fuzzy problems, which aren't very well defined, which need a good amount of consulting and discovery upfront for us to even define the problem and help shape the opportunity for the client. That is where we excel. And we believe that as the analytics maturity of organizations increase, some of the problems that they will go after will become more and more complex and fuzzier. And that's where we believe we will bring a lot of differentiation to the table.
Okay, thanks so much for joining in and sharing with us that view. That's Latent View. The stock is under a bit of pressure in trade in tandem with the rest of the market. But as we slip into a break, let's talk about the most talked about sector, that's PSUs and defense. Let's hear it out from some of the most top market experts. Atul Suri, Gautam Dugar, they share their views on these sectors.
What's surprising me is that after a phenomenal 22, they're also having a very good 23. And that really shows that, yes, when decadal trends change, it doesn't end in a year. It actually gets elongated. In fact, the whole PSU basket, if you see, it's not just banks, it's defense stocks. It's a lot of these, infra kind of plays. These are like everyone, people who've been in the market for 20, 30 years have sworn we'll never buy PSUs. Because many times in their life, they tried and they burned their fingers. They've given back 40, 50% drawdowns that have happened.
If the policy momentum disrupts in any way, irrespective of what is happening to their business, if there is a policy change, then the PE multiples can crash. Okay. Because they're end of the day government entities. Yeah. Their working capital balance sheets are very different because their biggest customer is government. Second, if for whatever reason the execution suffers, a lot of things have to fall in place for execution to materialize. So even if the policy momentum is supportive, but execution is not supportive and execution falls apart, then there is a possibility of a crack.
Our major themes going forward, and that's where we're very bullish on, is financials and discretionary consumption, and also affordable luxury kind of consumption that we're looking at. Discretionary is what we're looking at, and there again in say aspirational luxury. So obviously hospitality comes in a big way. Pure textiles move in here. There are shoe companies as such which come in, and obviously these are few sectors that are playing out for us.
Without labeling them as defensive or growth, I would say that bank today makes a lot of more sense, because whatever growth we are talking about in the economy, definitely it has to happen through the banking sector. I keep talking about IT as one of the sectors which I generally have a positive bias towards because of a simple fact that this is a very strong cash generating sector. And more importantly, this is a sector which also distributes a large part of the profit back to the shareholders. And hence, from let's say dividend yield or cash flow yield perspective, this is one of the better sectors to look at.
While the Indian consumer story is not lost to anybody, Indian consumer has been doing well for last couple of decades. You have a large middle class population where the dependency ratio is falling, per capita income is rising. So obviously Indian consumer story is not going anywhere.